Welcome to another explainer. Man, I am absolutely thrilled about today's topic because we're getting right down to the literal core of the financial markets. Today, we're decoding price action. We're not going to look at it as some mysterious, unbreakable code. No, we're treating it as the direct, zero-lag language of supply and demand. So buckle up because this is going to completely change how you look at a chart forever. Let's just kick things off by tackling a massive misconception right out of the gate. Have you ever looked at a chart and thought, hey, is technical analysis basically just a crystal ball for predicting the market? A lot of folks out there really think that if they just draw the exact right lines, they're going to know exactly what's going to happen tomorrow. Well, let's shut that myth down right now. The definitive answer is no, absolutely not. Technical analysis is actually a descriptive language. We use it to categorize historical data. It literally doesn't guarantee future movement at all. Instead, it assesses probability by reading past recurring behaviors. You're basically looking at a historical record to figure out the path of least resistance, not gazing into some magical crystal ball. Okay, let's dive into this, because this is how we actually solve that super annoying problem of market noise. If we treat the market like a language, we have to learn its grammar, right? So the individual words of the market are your single candlesticks. When you start stringing those words together, you get reoccurring patterns. Those are our sentences. And then when you take a step back and look at the whole picture, those sentences form paragraphs, which are your overall market trends. Put them all together, and they create a highly readable environment. And that brings us to the absolute biggest takeaway of this first segment. As the saying goes, you are not predicting what the market should do, you are observing what the market is doing. Trading is 100% about objective observation. Once you finally stop trying to guess the future and start objectively reading the language of the present, your whole perspective shifts. All right, let's jump to segment 2, candlestick anatomy and psychology. Now, I want you to think about this for a second. What crucial market narrative does a standard closing price line chart completely hide from you? It's a huge blind spot. When you're only looking at where a price finishes for the day, you're stepping right into a massive trap. You are completely missing the entire story of exactly how it got there in the first place. Well, a Japanese candlestick perfectly solves this hidden problem by giving us 4 really critical data points for any specific time frame. It shows us the open price, the high extreme, the low extreme, and the closing price. When you combine these, they capture this brutal, unedited battle between buyers and sellers, showing us the exact volatility that went down during that period. Just think about the psychology at play here. Long wicks, they reveal strong price rejection. Basically, one side pushed super aggressively, but the other side fought back just as hard. On the flip side, large bodies with tiny wicks show total directional conviction. There was no real tug of war going on. One side was in absolute control from the open all the way to the close. Let's solidify this with a specific example, like the doji. This is a candle where the open and close are virtually identical. It looks almost like a cross. This signals perfect equilibrium or complete momentum exhaustion. Now contrast that with the absolute dominating conviction of a huge Marubozu candle, or the aggressive one-sided rejection of a pin bar. The doji is just the market taking a breather to find some balance. Moving right along, let's look at section 3, volume, the market's fuel. So if price action is the what of the market, what measures the how much? How on earth do we gauge the actual weight, the financial intent, and the broad participation behind a price movement so we don't just get completely wrecked in a false breakout? The actionable solution here is volume confirmation. High volume means broad consensus. For a trend to actually be healthy, rising prices need rising volume, acting as strong fuel. But low volume? That indicates heavy skepticism and weak participation. If the price is climbing while the volume is actively dropping off, that divergence is a massive, flashing warning sign. Which brings us to a really major structural event you've got to look out for. Climax volume. This is a massive volume spike at the very end of a long, extended move. It represents total final exhaustion. It means literally everyone who wanted to get in has finally entered, and all remaining orders are filled. Since there is no one left to push the price any further, climax volume almost always marks a major structural turning point. Before we put all these pieces together, a quick shout out to TradingView. If you want to apply these volume and price action concepts on the best setup out there, save $15 using our referral link in the description to get the standard in charting. Trust me, you're gonna want pristine charts for what we're covering next. Okay, let's jump back in. Section 4, mapping the trend structure. Listen, when you have your own capital on the line, emotional guesswork is literally your worst enemy. You might feel like the market has gone way too high or maybe dropped way too low, but how do you objectively know who is actually in control of the market at any given second? You have to look at the mechanical structure. An uptrend is completely objective. Step 1, the market prints higher highs. Step 2, the market prints higher lows. Step 3, as long as that pattern continues, the uptrend remains structurally intact. This objectively proves that buyers are consistently willing to step in at higher prices, and sellers simply can't break previous support. Absolutely no guessing required. And this perfectly illustrates the other side of the coin. A downtrend is driven by persistent supply, mechanically printing lower highs and lower lows. Sellers are running the show. But then we have consolidation. This is a sideways, horizontal range where the market is basically in a state of relative value. It's just resting, waiting for new information before breaking out. And remember, a true breakout from this range, that's going to require that massive surge in volume we just talked about. And that brings us to our final section, context and reading the tape. I want to challenge you with a really crucial question. Why do isolated, perfect textbook candlestick patterns frequently fail? Like, why is trading a standalone reversal pattern in the middle of absolute nowhere incredibly dangerous to your account? It's because context is literally everything. A pattern without structural context is just pure noise. A beautiful bullish pin bar means absolutely nothing in isolation, especially if it's just chopping around inside a tight consolidation range. But if you get a bullish pin bar occurring on high volume, printing exactly at a higher low within an established uptrend, boom, that is critical, actionable data. The structure gives you the map, and the candlesticks give you the real-time directions. Now, to really lock this all in, for additional solutions and an incredible deep dive into modern market strategies, you need to grab your copy of The Funded Micro, Modern Future Strategies for the Prop Firm Era at franksreport.com. It is an absolute must-read to master your mechanical risk management, contract sizing, and the disciplined scaling rules we've built up today. So as we wrap up this explainer, I'm going to leave you with a final provocative thought to take into your very next trading session. Are you predicting the market, or are you observing it? The path of least resistance is sitting right there on the chart, speaking to you in the lag-free language of price action. Respect the objective data over your own personal biases, and just let the market tell you its story. Thanks for hanging out, and keep learning.